This is the NVIDIA macro outlook for the week of June 15, 2026. Over the next few minutes, we're going to step back from the day-to-day noise and look at the bigger picture, where the Federal Reserve actually is, why valuations are flashing yellow, and why, underneath all of the fear in the headlines, one of the largest capital spending booms in modern history is still very much alive. If you trade or invest anywhere around technology and power, this is your map for the second half of the year. So grab a coffee and let's get into it. Let's start with the one-sentence version of this week. The market handed us a textbook lesson in patience. We saw a sharp sell-off in semiconductors, a wave of fear in the headlines, and then a quiet reminder that the long-term story hasn't actually changed. The mood out there right now is jumpy and emotional. But here's the thing. Jumpy markets are exactly where disciplined investors separate themselves from the crowd. When everyone else is reacting, your edge is having a plan. So the theme for today is simple. Respect the risks, but don't lose the plot. Start with the Fed, because in this market, everything else hangs off it. Policy right now is best described as a hawkish hold. The federal funds rate is sitting in a range of 3.5% to 3.75%. And the Fed has made it clear it is in no hurry to cut. Inflation has cooled, but not enough for them to declare victory. For markets, that means the cost of money stays high, and the era of free, easy liquidity that powered the last decade is simply not coming back anytime soon. Rates this high are a direct headwind for richly valued growth stocks. When you can earn a safe 4-ish% in cash, the bar for owning an expensive stock goes way up, and that tension matters enormously for everything that comes next. Timing matters, so mark your calendar. There are 5 Fed decision meetings left in 2026, June 16th and 17th, which is this week, then late July, mid-September, late October, and a final one in December. Each of these is a potential volatility event, a moment where the whole market can turn on a single sentence. The June meeting is the nearest catalyst, and the key isn't just whether they move rates, it's the tone. Your position sizes should respect that these dates exist. Going into a Fed meeting fully leveraged and fully exposed is how unforced errors happen. Now the part that should keep you honest. Valuations. By almost any historical measure, this market is expensive. The S&P 500 is trading around 24 times forward earnings, and the cyclically adjusted price-to-earnings ratio, the CAPE ratio, is sitting north of 40. To put that in plain terms, we are in the top few percent of valuations ever recorded in market history. Now, let me be fair. Expensive markets can absolutely keep climbing. Price in the short run is driven by flows and narrative, not just math. But high starting valuations do 2 things you can't ignore. First, they lower your expected returns over the next several years. And second, they make the market fragile, primed to overreact the moment bad news hits. That fragility is exactly what we saw on display this week. So if rates are high and valuations are stretched, why not just sell everything and sit in cash? Because of this, underneath all the volatility, the real economy is in the middle of a genuine capital spending supercycle. Spending on AI infrastructure in 2026 is tracking somewhere around $660 to $690 billion. And that is not a forecast for some distant future. That is money being committed right now on data centers, on chips, on networking, and on the electrical power needed to run all of it. This is the single most important fact in the market today. The demand is real, it is funded, and it is accelerating. Whatever happens in any given 2-week window, that engine is still running. Put those 3 forces together, a tight Fed, expensive valuations, and a real funded capex boom. Combine them, and you get the core thesis for the second half of the year. Buy quality on pullbacks. Don't chase strength. When a genuinely great company gets thrown out with the bad news, that's your opportunity. When everyone is euphoric and a stock has gone vertical in a straight line, that's when you wait. It sounds obvious when I say it out loud, but it is the exact opposite of what most people actually do in the moment. The entire point of having a written framework is to let you act calmly when everyone around you is emotional. Which brings us to the big story of the week. The sell-off in semiconductors. Chip stocks got hit, and hit hard. Call it the kind of carnage that makes the front pages and really tests your conviction. But here's a signal worth noting. NVIDIA's chief executive, Jensen Huang, publicly framed the weakness not as the end of the cycle, but as a buying opportunity. Now, you should always weigh the source. The CEO of a chip company is, of course, talking his own book, but notice that his argument lines up cleanly with the capex data we just walked through. If hundreds of billions of dollars are being spent on AI infrastructure, the companies supplying the picks and shovels do not suddenly become obsolete because of a 2-week drawdown in the share price. Price and value are not the same thing. This week was a sharp reminder of that gap. So who is actually leading this market? In the conversation among serious investors and analysts this week, 2 names dominate. NVIDIA is still the center of gravity. It's the stock the entire market keys off of, for better and for worse. When it moves, the index moves, and the strength name people keep pointing to is AMD, increasingly seen as the credible number 2 in AI compute. Now, the takeaway for a macro investor is not to blindly pile into either one. It's to recognize that leadership in this market is narrow. A small handful of names are carrying an enormous amount of weight on the index. And narrow leadership is a risk you manage with position sizing and diversification. It is not something you get to ignore. Here is the part of the AI's story that is still genuinely underappreciated. However, you simply cannot run data centers without enormous amounts of electricity, and that reality has turned the once glamorous world of power infrastructure into one of the most interesting themes of the entire year. That includes the nuclear revival, and specifically small modular reactors, or SMR. A name like Oklo has become the lightning rod here. With a genuine bull versus bear split, the bulls see the future of clean, reliable baseload power purpose-built for data centers. The bears see a pre-revenue story priced for absolute perfection. And honestly, both can be right for a while. The broader point is this. When you hear the word AI, don't just think chips. Think about the entire electricity supply chain standing behind them. A quick word on crypto. Because it's an important part of the macro picture, the tone among the voices we track turned notably cautious this week. Even longtime bulls, Anthony Pompliano among them, sounded a lot more measured on Bitcoin than usual. And that actually fits the macro backdrop perfectly. When the Fed is holding rates high and liquidity is tight, the most speculative, highest beta assets tend to feel the pressure first, so caution in crypto is often an early read on the market's overall appetite for risk. Even if you don't own a single coin, it's worth watching as a sentiment gauge for the whole risk landscape. So how does all of this translate into an actual watch list? A rules-based framework, and to be very clear, this is a decision support tool, not a set of recommendations, keeps servicing the same theme over and over. Own the infrastructure of the AI build-out, not just the headline chips everyone already knows. 3 names capture that idea nicely. Ethan, ticker ETN, for data center power and electrical equipment. Fabrinet, ticker FN, for the optical components that physically move data between AI chips at the speed of light. And Monolithic Power, ticker MPWR, for the power management semiconductors tucked inside the servers themselves. However, optical power chips, the unglamorous layers that every single AI dollar has to pass through on its way to getting spent. Let's bring this home to the week ahead. The one date that matters most is the Fed decision on June 16th and 17th. Going in, the playbook is straightforward. Don't make big new bets right before the announcement. Keep some cash ready and let the volatility come to you. If quality names sell off hard on a hawkish surprise, that is precisely the pullback this whole thesis is built around. I'm biffed. And if the Fed sounds softer than feared, the AI leaders will likely catch a bid and run. Either way, the goal is the same. You want a plan written down before the headline hits, not a panicked reaction after it. Let's summarize the entire macro outlook in 5 simple lines. 1. The Fed is on a hawkish hold. High rates are the backdrop for everything, not a temporary blip. 2. Valuations are stretched, which means your margin for error is thin. Be selective. 3. The AI and power capex supercycle is real and it is funded. That is the engine underneath the whole market. 4. Buy quality on weakness and do not chase strength. And 5. Respect the calendar, because the next Fed meeting is just days away. That's the framework. It's simple, but simple is not the same as easy. And that's the NVIDIA macro outlook for this week. If this helped you think a little more clearly about the second half of 2026, do me one quick favor. Hit subscribe and drop a comment with the one name you're watching most closely right now. I read all of them. Now, one important note before you go. Everything in this video is for education and information purposes only. It is not financial advice. I don't know your personal situation, and every single buy and sell decision is yours and yours alone. Please do your own research and always manage your own risk. Thanks so much for watching, and I'll see you in the next one.